Hi, welcome to the Red to Black podcast. Here, you will learn how to invest in highly profitable private businesses to create abundant financial freedom. If this topic interests you, we invite you to subscribe to our channel. This podcast is hosted by Werner Minchel, ex-Marine aviator and current real estate investor, and Mario Parzino, current Marine infantry officer and business investor. Good afternoon. This is episode 16 of the Red to Black podcast with your hosts Werner and Mario. We are coming to you live from Los Angeles. Mario, how are you doing?
Doing well, Werner. It's glad to be here.
What do you think of Los Angeles?
Well, parts of it are completely apocalyptic, and other parts are beautiful and wonderful and lush and green, and people are doing well. So it's both of the extremes.
Yeah, I agree with you on that. There's areas like Beverly Hills, Culver City, Pacific Palisades that look like country clubs, and then there's other areas where there's just a ton of homeless and other activity. So it's an interesting disparity between what happens when you have a very sort of socialist system and you see this disparity between wealth. It's evident in Los Angeles.
Yeah, so yesterday I walked up Main Street in Los Angeles from Union Station to Mid-City, and it was just bombed out. I guess I wasn't too far off of Skid Row. And then today, getting to Culver City, it's just the top 1%.
Yep, that's how it is, and that's kind of the sad thing about our country, and it's also the opportunity for our podcast for you hungry listeners. If you're interested in really growing your wealth, the things we teach in this podcast will 100% support you in doing that. Also, let's go over the 6 topics. Return on invested capital, number 1. Number 2 is free cash flow margin. Number 3 is cash flow from investing. Number 4 is cash flow from financing. Number 5 is enterprise value. And number 6 is turnover ratio. Mario, what are your thoughts on return on invested capital?
Yeah, we use return on invested capital to determine how good a business is at using its capital to generate earnings. So if it spends money into the business every year, how good as it is returning that money into free cash flow or into operating income that they could deploy elsewhere. So there's an equation that we use. It's net working capital plus net fixed assets, which are property, plant, and equipment, PP&E. So that's the capital that's invested into the business. Is net working capital plus net fixed assets minus or subtracting the excess cash. So that's cash and cash equivalents that aren't deployed. So we use that to determine what kind of assets have been plugged in or what kind of cash or returns are we getting from the invested capital into the business. And we use earnings before interest and tax or operating income as our numerator as opposed to net income. So that's how we're comparing company A to company B. How well are these companies at generating earnings from the capital that are deployed in the business? Quick story for you, Werner. Your dad, when I was up in Jacksonville one fall, your dad talked about this guy that had a tree business, a Christmas tree business. Do you know who I'm talking about?
Somewhat. I don't know the individual personally.
I think you do, or your dad's friends with them. I don't know if you introduced me to him or your dad did, but he owns a business that only operates for 3 or 4 months out of the year. And he goes up to Oregon and he buys up hundreds and hundreds and hundreds of Christmas trees, thousands of Christmas trees. And he brings them down to Los Angeles and Phoenix and Las Vegas. And he has all these Christmas tree lots in the desert. And he sells these Christmas trees. And understanding his business or understanding what he does, he's doing an incredible amount of business in 3 or 4 months on very little deployed capital into his business. And he obviously has the Christmas trees and he has shipping costs, but the actual fixed costs, his plant, property, and equipment is very minimal. So he's getting north of 50% on the money he has tied up in the business. It's a wonderful business. Now it's scale. It's very hard to scale that business nationally or globally, but the Christmas tree business in Southern California, Phoenix, Las Vegas, how this guy runs that operation is a phenomenal business. And we talked about some other businesses I've seen in the past that are able to generate these huge returns on invested capital. And that's because they don't have a bunch of depreciating assets tied up in the business. They don't have a huge factory and tons of equipment that are and trucks and things that are just constantly depreciating. It's run extremely lean. What are your thoughts on that?
So what you're saying is the net working capital that you put into the business plus the net fixed capital, it returns a certain revenue. So what that's telling us is that that cash has a certain amount of efficiency when you put into a business. So
That's
different
right.
businesses, that cash is more efficient, meaning if you're in an oil business, it's not very efficient because you're pumping more and more cash to maintain the pipelines that are crisscrossing the country. You're maintaining your upstream, downstream, midstream, the whole shebang. That requires an intense amount of capital because you're dealing with weather elements, you're dealing with oil running through the lines, you're dealing with so many external factors. But when you come to a Christmas tree business, you're literally cutting it down, putting it in a truck, delivering it, standing up, and selling it. It's a very simple business model. So if we look at a business such as Oracle, it's not as simple of a business, but once you get it up and running, it's an extremely sort of simple business to scale out. And it's a business that efficiently uses your cash because you have the servers running, and all it requires is maybe adding a new server, adding some more space on the server, adding a better HVAC system. It's real simple. And then you're running the software. And if another client like a bank comes on, you're just partitioning more space to that bank, and they're running on existing software that you've already developed. You're not developing that software over and over and over again like the oil pipeline. You're constantly sort of redeveloping it. You're putting on new gaskets, you're putting on new stop valves, you're putting on whatever else is required in that business. And it's just an insane amount of cash that goes into it. So when you're looking at a business, you want to really look at what your return on invested capital is, because you're going to ask yourself, if I put $100 into this business, how much is it returning me? An oil business, say it returns $5. Oh, well, okay, that sounds okay. Then I go to the Christmas tree business, it returns $50. That's a much better business. So what are your thoughts on that?
Yeah, I mean, the guy doesn't have a lot of capital tied up in trucks. Obviously, he's contracting the delivery of the Christmas trees from Oregon down to Southern California, Phoenix, Vegas. He has a few machines that tie up the Christmas trees so they can load it into the back of somebody's SUV or pickup truck or on someone's roof. But these are very minimal capital expenditures in the business, and that machinery isn't tearing itself apart every year like an oil rig or like these pieces of drilling equipment. You've seen that stuff out in Wyoming. These pieces of machinery, they're so powerful. This machinery is constantly ripping itself apart. It's not only is there constant maintenance to that, but it's constantly needing to be upgraded or to be replaced. An oil company, if everything goes right in an oil company, you're right, you can eke out a 5% operating margin on an oil company. So you have to be a massive company. That's why they call them like vertically integrated oil companies. You have to grow that thing so big to actually generate real earnings, such paper thin margins. This guy is doing a Christmas tree business, which on paper, or it's not something you're going to brag about to people how how intelligent you are doing Christmas trees. But the reality is the underlying economics of that business crush the oil business. If you're not comparing obviously the size, but you're comparing the return on invested capital. If I buy another machine to wrap Christmas trees, what is my return? I get another lot. I sign a lease. I sign a 3-month lease, 4-month lease on a Christmas tree lot. I get some travelers, some winter travelers to come there, mom and pop in their RV to sit on these trees and sell them for me. What is my return on that investment? And it's way north of 50%. So it's an excellent. This guy was really going after the better business and not the better story or the better there's less ego wrapped up in this. The guy was just and he was skiing in Jackson Hole by Christmas every year. So those are kind of my initial thoughts on return on invested capital and why it's important for businesses.
Yeah, so return on invested capital, why are we discussing this for our listeners? It's because when you go to invest in a business, or let's say you're building your own business, it's essential to know how far your cash is going to go. Let's say you're going to build your own business. If you have a business like an oil business, it's going to be a huge uphill battle. Your margins are thin. I know I've heard when I was in Wyoming from guys that worked on our construction projects, they would tell me, as you said, these drilling rigs go down thousands of feet and they require a lot of pressure. They're extremely dangerous. The thing could blow up at any second and require to be cooled off at all times. And also, I've heard the smaller rigs, smaller outfits will only start pumping oil when the oil price is at a certain price. So if it gets too low, they'll just shut down operations, store the rigs, and move on to other things. So the reason why we're talking about this is when you're in looking at these businesses, you want to look at a business where it's a simple business like a Christmas tree business where you could grow it in 4 year time. So let's just say you're working 40 hours a week. You're making 50 cents on the dollar versus 5 cents on the dollar. That enables you to have the ability to stack cash to weather storms, to stack cash to reinvest in other business opportunities, to stack cash to invest in other businesses outside of your business as a passive investor. There's just a whole host of opportunities you get out of high margin businesses. And that's why we're talking about it, because our goal is for you, the listeners, to grow your wealth exponentially, whether you're just a dentist or maybe you're a real estate investor, wherever you are in your investing life cycle, you can never go wrong with high profit margin business. You can always improve your investment strategy by looking for high margin businesses. And I think we've talked about that one enough. Let's move on to number 2, which is free cash flow margin. Go ahead, Mario.
Yeah, free cash flow margin. So we're talking about free cash flow divided by your revenue, and we're looking for a business that's drowning in free cash flow. Why is that important? Is because those types of businesses have optionality when they have that much free cash flow generated each year. Is they can do really smart things with that free cash flow. They can go out and find other companies that will tie right into their business, kind of bolt on acquisitions to drive future earnings. They can pay us a dividend. So those folks that invested in that business and held on for the long run, they can get a really nice cash dividend each year because they're drowning in free cash flow. Or they can destroy other owners' ownership in the business or claim on the business. They can basically do share buybacks. They're kind of unpopular right now, but well, they're very popular, but I mean, society is kind of upset with these companies because the smartest thing they could do right now is a lot of these publicly traded companies can't find really good businesses to buy at good prices. So they're not buying, they're not doing as many acquisitions. So a lot of these companies cannot find high quality businesses for sale at reasonable prices right now. And most of them are paying a dividend, but what they're doing is they're deploying that cash to buy out other investors. They're drawing down the amount of shares outstanding. So it's everybody that holds on to their shares is getting a larger piece of the pie. So we love businesses that are drowning in free cash flow or that have a high free cash flow margin because they're able to do so many things with that free cash flow every year that are positive, where a company that's just scraping by doesn't have a lot of options to grow their business. They have to really grow it organically, which is sometimes very difficult. It's sometimes much easier to go out there and buy bolt-on acquisitions than it is to grow organically. So thoughts on that, Warner?
Yeah, multiple points. Free cash flow is a metric. And from what you're saying, when a business sets a target in their mind, when they're a 20% or 30% operating margin business, and they tack on another business, they're going to think hard before they buy, say, a 5 to 10% operating margin business. They may only buy that business if it can generate 20 to 30% in the future because they make it more efficient, or maybe it's just a marketing play and they want that business to expand their reach. But as you were saying, it gives you way more options because now you have cash actually in your coffers. And that's what free cash flow margin is saying. It's actually looking at the cash flow statement, which is actually what the cash is doing, whereas the income statement is more designed for tax purposes. So in our last example, EBIT, earnings before interest and taxes, that's really looking at cash and non-cash items, not to get too much into accounting. And when you take it to the free cash flow statement, you're adding back in the non-cash items like write-offs and all sorts of other depreciation if you have that. And it's actually telling you, no crap, what cash is actually going to your bank account. And that's important to know because at the end of the day, that tells you how efficient your business is at creating cash. Is it 30% efficient creating cash? Is it 5% efficient at creating cash, what is it? But the free cash flow margin is an essential metric to know because it's actual on the ground metric that tells you the most important thing of your business, which is the lifeblood, which is cash. And that is key. What are your thoughts on that?
Yeah, one of our good points. We're looking for businesses that are able to generate a ton of free cash flow. So whether you're going to buy, whether you're looking for those businesses in the public market or the private market, it's absolutely critical that you do a deep dive. You understand some accounting. You go to the library, you take out some books, and you learn about accounting and be able to walk through these numbers and look at the business and say, is this a company that's returning high margins on invested capital? Number one, and two, what is the free cash flow? Those two numbers are gonna tell you in a tremendous amount of how efficient that business is at operating, or basically how good they are at selling things for a lot more than they have uh, producing those goods, a lot more for a lot more money than they have into the goods that they're selling, the goods or services that they're selling. It's miserable. Some businesses are just designed to be just miserable businesses, and God bless the guys that are in there working every day frantically to try to eke out a profit. And I would say the airline industry comes to mind right now, as these guys are extremely talented, extremely hardworking, but they are just barely squeaking by on free cash flow. And a lot of their assets aren't even owned by the business. They're having to lease it from banks, the airplanes. It's just a really miserable business. There's other businesses, the candy business. There's a California candy business called C's Candy, and it's now it hasn't. The problem with C's is it's never been able to really grow that popular outside of California. It's always trying to break through to get the same ambiance it has in California and other regions of the country. But that business is phenomenal at free cash flow and generating earnings on a very limited amount of capital that has to be invested into the business every year. It's got it's got some equipment, it's got a factory, it makes a ton of candy. It doesn't have to keep building extra factories, and the machinery that they have is not ripping itself apart like an oil drilling rig. So yeah, before you start going into these businesses, doing a deep dive and understanding what amount of income has to be, what amount of cash has to be deployed into this business to get a certain amount of operating income, and then how much of that it actually sticks to the bones as free cash flow. It's critical to understand.
So rehashing what you're saying is there's certain businesses that are poor performers and there's certain businesses that are great performers. And when I mean performance, I'm talking about their ability to generate cash. Some businesses, like you said, they're needed businesses like airlines and other businesses. They're just not high operating margin businesses like such as an Oracle, the Christmas tree business, or any other small business. We talked about jet skis in the past. There's these small businesses, large businesses that are really good at generating cash. And here's the thing, for anyone listening to this podcast, you have a choice to what business you're going to go into, unless you're in a communist country and you have no choices. If you're not, and you have a choice, pick a business that's going to generate more cash because in the end, it's going to make more money for you. You're going to sleep better at night. You're going to have more opportunities because that cash is really all cash is a medium to exchange goods and services. And the more you have of that means the more purchasing power you have. So with that purchasing power, you can go out and take advantage of certain opportunities, which Mario and I think are coming in terms of buying undervalued businesses. Cash really enables you when you have a bunch of it and you're running real lean. It's a really important point. It really enables you to really seize these opportunities. I mean, there's multiple things. Seize opportunities, calmer mindset, be able to weather storms much better than say a company that's eking to get by. There's a whole host. We're only naming a few, and I think that's probably pretty good for free cash flow.
Yeah, just one more
Let's,
point on that,
oh yeah,
just
go
to
ahead.
reiterate what you said is whether you're going to be an employee of a business, you're going to buy a business, or you're going to start a business, going after these types of businesses that are high margin, they generate a ton of free cash flow, high operating margin businesses. There's going to be way more opportunities in those types of businesses than there are on low operating margin businesses like the airline business. As soon as there's rough weather, those businesses are laying people off. They're not promoting people. They're not growing and expanding. They're contracting. They're constantly in this fight to just stay alive. Where a better business, even though it might not be as sexy as flying these beautiful jets around the world. The Seas Candy business, a Christmas tree business. Some of these businesses, it's not as delightful to brag about. That there's not as much ego in it, but they're actually better businesses at generating free cash flow. So there's going to be more opportunity, whether you're an employee, you're the owner, or you're going to start that kind of business.
Yeah, great points. Look at cash flow is the blood of the business. Lower operating margin business, I think, is a weaker, let's say, more unhealthy business. I mean, they
That's
could be
right.
doing everything right, but as soon as they get a cut or they weather adverse storms, then they're starting to bleed. And look at your cash in that manner. Where are you going to give that blood, your cash, to what type of business? Do you want a really fit, strong business that can weather any storm? And when you get cut, it's just maybe a few drops of blood? Or do you want a business that's weak overall in terms of performance, that when they hit a storm, they're draining a lot of blood? What that means is you're going to be losing a lot more cash in that business versus the other business. So let's go to cash flow from investing. Can you break that down for us, Mario?
Yeah, cash flow from investing is really important when you're looking at insurance business. If you're into any type of business that is generating a lot of temporary float, like insurance, they're taking in other people's money that they're eventually going to pay back. So they're taking in these premiums every month. Just think car insurance. They're taking in $35, $55, $75 a month to insure people's cars. And eventually they're going to pay that back out in an accident, maybe 5, 10 years from now. But in the meantime, if they've done their due diligence or they've done the right actuary tables correctly, if they've priced risk correctly, they get to hold that money for a period of time, 5, 10, 15, 20 years until they pay it out in a claim. That's considered float. Now, they should be generating money off that money that they're holding. So, one of their favorite things, one of their favorite activities to do, which will show up on uh, cash from investing, is buy multifamily real estate. So they'll go to Austin, Texas and buy 500 units. So they've taken that cash that they're collecting up $35 at a time, they're deploying it into a huge multifamily property, and then they're getting income off of that property every month on the rents, and hopefully that's generating a lot more money that they're going to pay out eventually. So when it comes time to actually pay out, they've got plenty of cash available. They've got all these rental units that they can pay off those claims. So that's where you should see a lot of cash flow from investing in those type of businesses, because it's healthy for those type of businesses. Now, a car business like Tesla, if Tesla is making a bunch of money off of gambling on Bitcoin and it shows up as cash flow from investing, it's not as positive, because the underlying business is building cars or battery terminals or battery technology. That's what you kind of want to see. You want to see a lot of operating income. If you're seeing a ton of money, they're making almost no money selling cars, but they're making a bunch trading digital currencies. You're kind of suspect about how good they are at their underlying business, which is building cars. So that's kind of my initial thought on cash flow from investing. Over to you, Warner.
Yeah, great thoughts. So, cash flow from investing, in terms of looking at, let's look at Oracle's financial statement. There's sort of three areas, and you covered some of them. And what they all point to, before I go into them, is what you said, is when you have a lot of cash, you have the opportunity to take that cash and go out with it and invest it somewhere else. That's what cash flow investing is telling us. So the cash flow statement's like this waterfall down. Cash comes into the coffers, tells you, okay, I got 30% margins. Then, okay, now I have all this cash. Well, I just don't want to sit on it as a business. So where am I going to invest it? Looking at Oracle's statement, you can invest in marketable securities. So, like you said, looking for a similar business as yours that's a viable business, maybe another database company or whatever marketable securities works for your business. Maybe it pays a dividend, whatever your investment goals are. You have that cash to make that investment. Then there's acquisitions, number two. So securities number one, acquisitions number two, and you're doing stuff like buying buildings, or maybe you're buying another plant, or maybe you're buying another business. in all of these things that are adding to your business. And then number three is your capital expenditures. You're taking that money and you're re-improving, battle hardening your own business. And that's what the cash enables you to do. It gives you, like you said before, we're hammering this point home, because when you have more cash, it enables you to do multiple things like invest in other businesses, acquire other businesses, or improve your own business. And that's huge. If you're in the oil business, you're like, hey, we're just going to patch this pipe over here so it doesn't bust, but we don't have the funds to do this. And then 5 months later, there's a huge bust in your oil pipe, and now you're managing that risk. It's just multiple headaches after another in that business. If you think about the logistical supply line of moving oil from Wyoming, say, down to Texas, to the ports in Texas, and then out internationally on a boat, getting across a massive sea to another country. Can you imagine the logistical nightmare that is versus Oracle, where a bank says, yeah, I'm going to buy your software as a service. I'm going to use that CRM system you have. I'm going to put all my bank information there. You guys secure it. And that's literally a phone call and a bunch of guys in the back end literally setting it up. It's set up and then it runs smoothly from here on out. Those are two completely different businesses. And you can see that one business sticks around for a while and another business just is literally refinancing, getting more bonds, reissuing more stock. It's just literally, it's like literally just a nightmare to stay afloat because they're constantly searching for cash, whereas Oracle is constantly making cash. That's the differentiating point I really want our listeners to know. What are your thoughts on that, Mario?
Good points, Warner. There's just better businesses. The oil business, I call it the rusty pipe business. It's just constantly needing it's constantly needing money that isn't going to generate you more money. It's just patching what you already have. It's just fixing the rusty pipes. It's fixing the machinery. Like all your profits are tied up in depreciating assets. It's a rusty pipeline. And if you're doing everything perfectly, you're squeaking out a little profit. Oracle, that beautiful Oracle font, spinning up servers and providing a wonderful digital service. It's really a fancy storage business. It's just like public storage. People move their stuff in there. They move their digital storage material or their physical storage material into this building, and they're like, I'm going to pay the monthly cost. And there's a high switching cost if you want to jump over to Amazon or SPA or SAP or IBM, et cetera. There's a huge amount of money and time that's going to take you to basically get the same service. So they're just like, I'm happy. I'm going to stick with Oracle. And they're able to ride out storms so much better than an oil business. Boy, when oil crashes, Warner, what happens to all the toys in Gillette? What happens to all the new trucks and the RVs and the campers and the four-wheelers? What's going on? What's going on in Gillette when the economy or when oil prices crash?
Basically, from talking to some of the tradesmen that worked on our properties, they actually warned me. They're like, you have no idea. Just to hit home the point we're talking about, I actually forgot about this. They're like, you have no idea what it's like in Gillette when this place bottoms out. Like we talked about that battle file, that what's that guy's name
Dallas,
again? I
Dallas,
completely Dallas.
Dallas.
Yeah, Dallas's battle file. We won't go over that again. Listen to another podcast if you want to hear about Dallas's battle file. And basically, he said that it'll just bottom out. And multiple people told me this. And he said, guys will come here, make all this money because they're paying 80, 100,000 a year. They'll buy all these toys. Oil business will bottom out, and then all these toys will be sold to someone else at 50 cents to 25 cents. I mean, at fire sale prices because they have to move. There's no Gillette's a town that fluctuates between like 15,000 and 30,000, goes up and down. Now with technology now, as we've talked about before, it's leveled things out. So the booms and busts aren't the greatest. So okay, they found one efficiency in one portion of their business, but it's still not covering over that business is an inefficient business, and it's shown by the local economy going from 15,000 to 30,000, 15,000, and they said it could happen literally in a matter of a few days. Literally, it could bottom out like that. Thousands of jobs cut, and people are out of there. So that's the example of why you do not want to own a business that's a low operating margin business, because the turbulence of that business is just it can go up and maybe it's going fine for a while, but at some point turbulence hits and that thing can drop off fast. Whereas an Oracle, it's just steady Eddie. You haven't heard about Oracle in the pandemic? There's no
No.
peep. They're not asking for money. I mean, maybe they
Nope.
ask for money, but I'm not sure. Uh, and yeah, that's it, man. Let's roll to, unless you have any more thoughts, let's roll to
Just
cash
one
flow.
last. I just
Oh, yeah, go
what
for it.
you kind of said about it's kind of the health of the business or the blood. It's the Gillette oil business or really oil companies, rusty pipelines. They've got like hemophilia. Like they get a little nick, there's a little tiny cut, and they're bleeding out. It's a tough business to ride out an economic storm. And then you've got like an old Italian lady who eats salads and gets a bunch of vitamin D. And it's like, man, it's so hard to kill. Like the flu can't kill her, pandemic can't kill her. Like this old Italian lady that I grew up with on the corner. I mean, she just lived forever. And it was like, yeah, I mean, she ate vegetables and she got a bunch of vitamin D. And that's Oracle. Oracle is just a business that keeps day in and day out, good economy, bad economy, sideways economy. They just keep making free cash flow. They have a high operating margin. They build more servers. They produce great software that just works. It's always running. It's every logistics company in the world basically they either were a customer of Oracle or they're going to be a customer of Oracle. It's a beautiful business. I'll end it on that, Warner. We can move on.
Okay, great. So cash flow from financing, that's where a business basically goes out into the market to look for money to support the business. So let's say a business like Oracle, hey, let's say interest rates are really low like they are now, and I know they've done this. They go out and they borrow money because they know they can pay that money back with their current cash accounts. So they're like, hey, this is almost essentially free money. We have a great balance sheet. Let's get some of this free money and buy some other assets or do some stuff with it, and we'll hold onto our cash and we'll flip that and we'll make a spread off that next investment. That's one way you can raise money. You can raise it through the stock market. So these companies look at, we've talked about this in the past, what's cheaper? Is it to go into the bond market where the interest rates are lower, or is it easier to issue more shares or buy back more shares? Whatever it is, it's there's these multiple strategies they can use for financing, and then obviously there's paying out their dividends. So there's multiple different things that these companies like Oracle can do to basically support their business. And those are just a few. What are your thoughts?
Yeah, so some companies I like to see that they're making money from financing. Other companies I don't. I have no problem with Oracle making money from financing if they're going to provide on-site servers for a company and they're going to finance. They say if you buy our servers, if we set up, we do your whole system, we set it up, we'll finance it at 3%. If you go out to banks, they're going to charge you 7 to 10%. We'll charge you 3%, and that's going to show up on their income statement as cash from, or a cash flow statement, cash from financing. It doesn't bother me. Ford Motor Company, if all they can do is sell trucks, if all they can do to sell a new F-150 is finance it at 1% or 0% or 1.5% for 60 months, it's like, well, your cars aren't good enough or the economy's not strong enough to actually sell them for cash, or people can go in there and just buy a truck, or they're going to get their own financing. But you're having to you're having to offload your vehicles at these really rock bottom interest rates. Yeah, it's showing up as cash from financing, but it's also showing you in that business, man, this isn't a very robust business. It's not an Apple. It's not something where people are just going out and buying the product because they're passionate about the product or they really connect with it. It's a wonderful, or it's just like Oracle. It's just they need it. They want that security and that service. When I'm a little leery if Tesla's making a bunch of money off of financing Teslas, because you're like, man, you're having to incentivize people so strongly to buy this car. Is it really that great of a car? So different companies, it's okay in some industries to see some profit from cash from financing. Other companies, or industries, I'm a little leery when they're getting a huge return. They're making a ton of money off of financing. Thoughts on that, Warner?
Yeah, two thoughts. That what that's telling us, what you just described, is the underlying business actually generating cash? Because the financing is kind of like, for a business like Oracle, maybe it's like an afterthought. I mean, maybe that's watering it down too much, but it's really like, if they didn't finance anything, they would be fine. They're just looking for ways to to basically either repurchase common stock or proceeds from issuance of common stock or paying out dividends. They're looking for different ways to use their cash,
That's right.
build more cash, but it's not their, as you were saying, it's not their primary goal. The primary goal should be the cash flow from operations. You're operating a business. And
That's
this is
right.
where we get into these gimmicks. Whether you're investing in a public business, which you have information for, or you're building your own private business, always look at return on invested capital, cash flow margin. Those two things will tell you a ton. Those are the most important things in a business. I mean, at its core, business is so simple. I put in $100. What do I get back? It's no more simpler than that. It's just, I mean, just drill it down. As ex-Marines, drill it down to a private first class level. How much do I put in? How much do I get back? If that's not working properly, and now you're going to do these gimmicks where you're like, oh, I'm gonna get revenue by giving you this car. And look at car companies. It started at 3 years, now it's 5 years, now it's 7 years. I don't know if it's going higher, but the financing just keeps extending because the cars get more expensive. And to get people to buy these cars, it's like this gimmick. Hey, I'll give
That's
you
right.
financing to buy it. Well, why can't you just sell the car for cash and then reap the rewards? Because they can't, because of their business model. It's gotten so expensive. Now they're getting into these financial gimmicks to get that product. And I haven't looked at Ford's income statement or balance sheet. I'm not sure what their margins are. It's just always go back to it's a business. What's the operating margin? Look at that. That's your core thing. When this business operates, what does it return? Cash flow from investing, cash flow from financing is when you have a healthy business. It's that excess cash. What are you doing with it? Or if you're going to the debt markets, okay, I can raise cash cheap. That'll help me out and I can keep cash in my coffers. If it's non-recourse, even better. Then if something goes awry, maybe I write it off. The point is it's Mario and I keep repeating this over and over again because it's so easy to get caught in the flashy things going on around you, the
That's right.
appreciation, the oh, this business is so great, like Tesla, and people are packed into Tesla. It's like, do you even know what the operating margin of that business is? Like, what if you didn't have all this free money? I'm going on a little rant here. Free money from the markets. What are you gonna? What would you really invest in that business? Probably not.
It
And
has about a 3.5% operating margin, and it's trading at 1,000 times earnings. So it would take you, if nothing improved in the business, it would take you 1,000 years, and that's net income. That's not operating income, but it would take you roughly 1,000 years to get paid back if nothing improved in the business. It's such a gamble, and people aren't investing in it based on the operating income or free cash flow margin. They're investing based on appreciation. They're trying to guess that somebody else will think it's more valuable next week, next month, next year. It's just an appreciation hustle, and they don't pay dividends, so it doesn't pay. Again, it violates our first rule. It doesn't pay you to own it. So why own it? Well, because you're gambling. People are speculating on. Hopefully, it's worth more next year. It's just appreciation. It's an speculation.
yeah, so what we're talking about is the difference between performance and gambling. Gambling is determining probabilities. Performance is looking at the past and looking at the performance of the business, and it's also an assumption. It's, I mean, everything's assumption. Nothing's perfect, right? It's an assumption that the business is going to operate in a certain way in the future. Yet if you look at like the brand of the business, the operating margin, you can handle a lot more bumps in the road by going back and looking at the performance of a business. So in this whole podcast is based on how does a business perform, because when it performs better, your money performs better. And a lot of people don't get that link. A lot of people are focused on this quick money, like you and me building this podcast. I mean, we're honest, we have 10 subscribers right now, but we're going day in and day out, building the foundation, building the network, building the people, building the value. And people, because of how minds are set up, people, it's so easy for people to get caught in emotion and behavior and get tricked by these financial statements, which can be intense and deep. And or even if they're looking at a private business, they're tricked by the guy telling them, oh, we make this amount. But if you knew how that business operated, you could catch the guy in these little white lies, or the gal, whoever's selling you the business. So it always goes back to revenue and expenses. It's really simple. Just your simplest bit Christmas tree. How much does it cost? How much do I sell for? At the end of those 4 months, what do I make? How much did I put in? That's it. If you know that about most businesses and you can verify that, in fact, you will do very well. And you pick 35% operating margin businesses that actually pay you to own them, or you invest in those businesses and then you get a return on your money because of the cash flows coming in, you scale them, you will do extremely well in your life.
Absolutely, Warner. There's a much higher probability that you'll do well right now today. If you bought Oracle, you do a lot better than spending 1,000 years on worth of current net income on the price of Tesla. It's a real gamble, and it's flashy. Everyone's excited to see what Elon Musk can do with technology. Again, it's a wonderful story. I'm glad he's an American now, and he's working in California and Texas, and he's gonna do wonderful things. But as far as an investment, I'd say that's way further along the speculation line than pushing some money towards Oracle, especially in a down market. If we experience some sort of contraction in price or values, Oracle's going to look real good. And it's going to be bad for those people that bought into Tesla at these multiples. It's going to be you're gonna have to hold that for a long time, potentially never comes back, but it's going to be a long run to get your money back out of that company. And we've seen this before in history, and we'll go into that detail in another podcast. So that's my last thoughts on cash flow from financing.
Yeah, so let's jump into enterprise value. And you touched on it before with Tesla getting your money back in 1,000 years. So let's look at what enterprise value is telling us.
Okay, so enterprise value is a financial term. It talks about enterprise value is what it would actually cost you to buy the entire business. And you can break that down on a per share basis, but it's not as simple as just buying all the stock. So if we wanted to buy the entire business, what would we have to what are all the pieces that we'd have to purchase and put together to actually own the entire business? And you start off with market capitalization, or all the outstanding shares. And even at that, in a big company, it's hard to get a actual number of what would it cost to purchase all these shares, but we can kind of come up with a general assessment based on market capitalization. So you buy all this stock, and then you subtract the market value of debt. Correction, you add the market value of debt. So you buy all the stock, and then you have to pay off all the bankers or anybody that has debt in the business. So real quick here. So you start with all the shares outstanding. That's including preferred equity. So if there's any preferred equity in the business, which is kind of like a bond and an equity, you're buying all the shares outstanding plus all the preferred equity, and then you're paying off all the bankers or everybody that's got a claim on the business because they've lent money to the business. There's debt in the business. And in doing so, if you did all that, you would also get the money that's in the business. You would subtract out the money that's already, so it would be cash and cash equivalents in the different bank accounts that are in the business. So I buy all the shares, both normal stock and preferred equity, common stock and preferred equity. I pay off all the bankers or all the debt in the business, but I subtract out all the cash I would get in those accounts. That's enterprise value. And why we want to calculate enterprise value is because we want to understand what it's going to cost us to buy this entire business. And if we did that, what are we getting on an earnings basis? So earnings before interest and tax. So numerator, enterprise value; denominator, earnings before interest and tax. That is one of the most important equations you can ever do in finance or investing or buying a private business or a publicly traded company, is to understand what is the enterprise value divided by the operating income. How many years of operating income am I paying for this business? If I bought the whole business, whether I bought a share of it or the entire business, how many years am I paying for this business? I like a multiple around 7.5. I'm really excited if I can get a high quality business that's selling either a fraction of the business or the entire business for 7.5 years worth of operating income. So enterprise value divided by operating income, if that is 7.5 or less, you've got a great deal. You've got a fantastic deal. And the reality is most small businesses with rational owners, you can walk down the street and knock on a laundromat or a car dealership or a coin operated laundromat, and they're not going to sell you that business for 7.5 years worth of operating income. And then there's other businesses that are far better than that in the publicly traded space, or people are going through a divorce, or there's some sort of divestment of this business, and it's actually a better business. But because there's there's a non-economic bias tied into the business, i.e., divorce. They want to get rid of it. They don't want the business anymore, and you're getting a better business than you could get. You're getting a wonderful business, and sometimes it's selling at 7.5 times operating income, which you can't go down the street and find those businesses with rational owners selling for those prices. So, thoughts on that, Warner?
Yeah, great points. Breaking it down to real simple terms. If I give you $100, how long is it going to take you to pay me back that $100 from your business? Let's say I don't buy the business. Let's say I just invest in the business. How long will it take me to get that money back? So Tesla, 1,000 years. People don't think about this stuff because they don't understand that a business at its core is simply just making money and then paying expenses and keeping money left over. And then if you're an investor in that business, depending on how your contract is set up, whether it's through the stock market or a private business or you own your own business, you're going to pay yourself, or you're going to get a payment out of that investment at a certain amount that's proportional to the share in that business. If that's what you've set up, right, as a passive investor. So what people don't take into account is I'm buying Tesla for 1,000 years. And a personal example, I'll give you my house in Hawaii. You know about this, Mario. I bought that house for, let's say, I'll just give like fake numbers. Let's say I bought it for about 70,000, right? I bought it at the top of the market in 2009. I wasn't getting cash flow on it. It was providing me a place to rent, so my rent wasn't getting wasted. Yet I was paying every month to support that house, and some of that money in the beginning was going to the equity, some of that was going to the mortgage interest payment, and then I got a renter in, and all of it was going to the equity. So I improved the efficiency of that asset, my money going to that asset by getting a renter in there. Yet I was only breaking even every month. That was 2008, 2009. Got the renter in maybe 2010. Market tanked. It took me 10 years to get back. Really, really, probably about 8 years. And I know I talked about this the whole way. 8 years to get back to that 60 grand. And then in the last 2 years, it jumped to 80 grand and I sold it. The reason I tell that story is if you just buy on appreciation and you don't have a metric that's telling you when you're going to get paid back, or you're not getting paid back in my instance, I waited almost, when did I sell that? I bought it in 2007 or 8. I sold it in 2000. I think about 10 years I held that asset. So I waited 10 hard years. People are like, oh, just sell it, get rid of it. No, I kept telling you, Mario, I'm going to wait till it comes back. That's the challenge of buying a Tesla. If you get it at the wrong part of the cycle and you're not getting paid back for its value, enterprise value over EBIT of 7 point, or you're not even buying it at a 7.5 multiple, and you're not even getting paid a dividend, you you're buying 1,000. It's just insanity. You're buying 1,000 multiple. Who knows when the market goes down if it'll ever come back? Like you said, it's just people don't realize. If you look at the numbers, the insanity of that decision is 7 point, 1,000 divided by 7.5. That's the multiple you put on what you would pay for it. It's insane.
Well, I mean, if they've reached their market penetration on what they're gonna, how many electric vehicles they're gonna sell per year, and you paid 1,000 years worth of operating income or earnings, it's not even operating income, it's earnings, it's net income. Man, you're gonna die, and that business is not gonna be back to what you paid for it. The valuation does not make any sense if you have to wait 1,000 years to get paid back, because you're not going to live in this world. You're not going to live 1,000 years. So it's just absolutely ridiculous. And most people that are buying this company aren't even thinking about it that way. They're just thinking stock price. Okay, it's going up. Well, the stock price can go up and go up to the
Mario,
sky.
Mario, I know registered financial advisors. I won't name names who have bought or won who have bought that stock and rave about it. That tells you the insanity of the euphoria.
It's almost probably unlike anything we've ever experienced, almost in our lifetime. I mean, maybe the dot com, maybe when there was companies that weren't profitable, they were selling for hundreds of years worth of notional. I mean, it's just insane. I mean, this is we're just beating up on Tesla because it's an easy target, but there's multiple companies out there food delivery companies or boxes of food that are just
Yeah, we could go on and on
they're just they're
these
just
other
they're
companies.
zombie. They're really like zombie. They're not profitable. They don't make any money, and yet they're trading for like an obscene valuation. And you're like,
I
folks, man, a lot of people. Go ahead.
I worked for a driver delivery company in Los Angeles, and I calculated I was doing such low revenues each night that were going to my pocket that I calculated I was paying $5 an hour to deliver the food. That's how bad they are. I was paying $5 to deliver the food, and that's when I came to the realization because I was calculating the hours, I was calculating my gas, I was calculating the benchmark that you would put on your car to determine what your expenses are per mile driven, and yeah, it was like -5 to deliver the food. I mean, if you got a food order for say $20, they give you 10% of that, $2, and you're going from the middle of Los Angeles, maybe up into the hills, and the guy gives you a $2 tip, that's $4. You can do the math in your head on that one. You're barely covering gas. So you barely cover your gas, and then those expenses from the car, the miles driven, are eating you alive. That's what people don't understand about what we talked about in the beginning, the underlying economics of a business is essential to know. Are you more, or can we
No,
roll on?
I want to encourage folks to be entrepreneurial and to take risks and to think big and to execute. But the reality is when you're making an investment, it should be very shrewd. It should be very like
Exactly.
black and white.
Exactly.
Do these passion projects, go out there and execute. But at the end of the day, have a safety net in your own personal life where when you invest a dollar, this is about as safe as it can go. Again, look at the Oracle as your benchmark. If you can't find a better business at a better price than Oracle, you have no business investing in it. Save your pennies, stack up your nickels, and wait for a better time. So, okay, yeah, let's go to I think it's number 6. Is that the last one we're going to go for?
Yep, turnover ratio. And the reason why we picked that one is we're looking at businesses which we won't name. When they become more viable, then we can share it with our listeners. As of right now, we'll use a pseudonym. So you go ahead with this one, Mario. Turnover ratio.
Yeah, so if we are in a business that's, let's say, logistically heavy, I want to see that inventory. So we have raw goods that are coming through one of the doors, and I want to see as fast as possible. We've added value to those raw goods. We've turned it into a product, and we're pushing it out the front door, or vice versa. Things are coming in the front door and we're pushing it out on bigger trucks or smaller trucks, etc. So why is that important? Is because if we're sitting on inventory, that inventory isn't making money. If that inventory is out in the economy, if we're constantly pushing inventory into the economy, that can drive earnings. So these raw goods come in. That's working capital that we've deployed. Okay, it's working capital we don't have to do other things with. It's tied up in these commodities or these these inputs to our product. Then we add value to those inputs, those commodities, and we have a product, and we don't want to sit on that product. We don't want to be in the inventory business. I walk into some hardware stores, I walk into some businesses, and I'm like, man, you're sitting on millions of dollars of inventory, and I don't see it moving. I look for dust. I look, as this inventory got dust on it, that means it's been here for a while. It's been here for a month, 2 months, 3 months. It takes a little bit of while for a layer of dust. You put your finger on it and you're seeing dust. Dusty bottles are not a good, it's about as far as I want to go. But if you walk around different businesses and you see things that are dusty, that's a bad business, and that product's not moving. Those are my initial thoughts on turnover ratio.
Yeah, two examples that I looked online for, I think it was Walmart and Target. Walmart had a ratio of like 8, Target 5. So Walmart was moving 8 times more, Target 5 times. So delta of 3. So Walmart was more efficient. Now, obviously, there's multiple other factors. What type of goods is Walmart moving? If you're talking about a guy that's got a Ferrari dealership, he's not going to be moving inventory like a Walmart. They're
That's
two
right.
different business models. So the turnover ratio is going to be unique to the business, but the ability to look at financial companies, publicly traded companies, and get a benchmark, and you can use that on your own business, or even one of the best things to get information is just go talk to someone, go call people up in businesses, go work for that business, go intern for that business. You'll learn you'll learn so much by just talking to people that have business for a while, and they want to tell you, because most people are not listening with curiosity and intention to other people. If you're willing to listen and you ask someone questions, they're not going to give you the answer off the bat because maybe they don't trust you. But if you develop that trust and you're a genuine and authentic individual, they will give you really great information. So going out and talking to people, talking to salespeople that are working in the industry that you're looking at. You know, we went to Italy today, talking to people in a certain section that we went into. Hey, what's selling a lot here? That actually we didn't do that. We actually, I'll fess up, we didn't do that today, but I'm gonna do that in the future. Hey,
No,
what
but
sells a lot here?
we did get one key piece of it. You know,
We did,
almost
we
everything in the
won't go
store
into
we
it.
could
Yeah.
find, right? What was the one thing we were trying to order that we couldn't get there? And we were like, man, that's probably a pretty good business. It's water. It was that sparkling water from Italy. They were out of it.
Oh yeah. If you guys are ever looking for, I'm gonna plug because if Mario and I haven't told you, but I'm a connoisseur of food. I will go 4 to 5 hours in a new spot just looking for the best farmers and the place to source food. And my palate's been trained over many years, as Mario knows. And there's this one water company called Larissa. They didn't even have it in stock. It's a sweet, just a smooth finish water, and it's just, if you can ever get your hands on it, for the listeners, I highly recommend Larissa. I think it's Lurisia. Phenomenal water. I went on a tangent. Let's bring it back. You keep
Well,
going,
they
Mario.
weren't sitting on a lot of inventory. That those bottles that they have imported from Italy of, you know, sparkling water, finished water, whatever it is, they're not sitting on inventory. That stuff's moving. It's telling you something about that business. It's telling you something about the brand. It's telling you about the consumer. If you're walking around and you see a bunch of dusty bottles, man, that's, you're sitting on inventory, and that inventory is not making you money.
Yeah, I mean, great points. And there's a store called the Co-Opportunity Market, which I go to in LA a lot with the boys. And the beauty of that business is it's like, I think they have 2 to 3 stores. Started in Santa Monica. Now they have one over in Culver City. Really well run stores. It's like when Whole Foods started out, right? These co-ops. Whole Food, I think, was a co-op when they started out in Austin, Texas. In fact, it was. So this store, since it's not like a big Whole Foods, it's got a corporate structure from Amazon. They're able to test out different goods at a smaller level. And I noticed they had these one paleo friendly bars, and I noticed they came in and they seemed to be turning over okay, but I really love them. But then I went back to the store maybe a few weeks later and they were gone. They never carried them again. So that company knew something in their data. Even though I like them, there always seemed to be the same box there with the bars in there. For some reason, other individuals didn't like that bar because they didn't bring it back. But it could have been the placement, it could have been the branding, there could have been multiple things. But at the end of the day, the numbers tell you, hey, this isn't selling at our certain benchmark requirement. We're going to put something else in that shelf space. It was on the cap of the cash register as you're walking towards the cash register. It was on like the right sort of register, and they didn't bring it back. So that's the power of a turnover ratio. It can actually work for you. It could actually work against you depending on how you place things, but it'll tell you how fast are things moving. And I guess in the case of that one, this is an assumption. It wasn't turning over as fast as their benchmark or their metric that they were looking for.
Right, they've got that broken down with current software. They can break down every category within their store, so they can compare water to water, soda to soda, beer to beer, and they can see the turnover of that inventory. And if it's taking them down, meaning they're sitting on more inventory. Now maybe they have a special. They cut a deal to get or the producer of that product cuts a deal with them and say, hey, I'll give you 30 days, same as cash. I won't come back for this to collect on this product for 30 days. So it's not costing them any money for that inventory to sit for 30 days, but they're monitoring it to know, hey, should we tie up working capital into this inventory to have this for our consumer when they come in here, so they're not disappointed, so they don't go somewhere else? Or no, this stuff sits here too long. It's bringing down, it's lowering our inventory ratio, or our turnover ratio. It's lowering that to a point where, man, we are sitting on stuff way longer than our competitors, which means we're not as efficient. And no, this for our consumer, this product isn't right. And getting that type of inventory analysis, or the software to analyze your inventory, is critical for definitely a grocery store, definitely any type of store that has hundreds or thousands of products like Walmart. Is they're going to know that. You go to Arkansas and you take a deep dive into their software. It's incredible what they're looking at and determining, what's the right price, how long has this been sitting, and should we continue to carry that? Almost to the point, like I've just a quick story of a nephew up in Alaska, and he talks about Walmart buying just enough of these huge shovels that actually rake snow off your roof in the wintertime, so they get so much snow in certain parts of
Wow.
Alaska. And they
Yeah.
only buy a certain amount. They pretty much know exactly how much you're going to sell. Now think about if they have excess of these huge, long 30, 40-foot shovels in April. If they have a bunch of those sitting around in April, well, they don't want to. They're going to have to hold that all the way until November, December, when it has the first big snowstorm. So they know, man, we're only buying X amount of these shovels because this is what our consumers are going to buy. And it's like, man, they've got that down to a science of exactly how many snow shovels they want to hold on inventory for, let's say, 3 or 4 months during the snow season of Alaska. And that's what they buy, and they buy no more than that. And it was just interesting learning through his experience. Man, these things are very hard to come by. If you don't get them when they're on the shelves, they don't order any more of them because Walmart knows not to sit on that kind of inventory.
Yeah, great points, Mara. So that brings us to the end of our podcast thing. We'd like to thank you guys for taking time out of your day to listen to this podcast. If you like the content, we ask that you subscribe to our channel, hit the bell notification so you get reminders when we post new podcasts. And as always, we look forward to connecting with the future. Thank you so much. Thank you for listening to the Red to Black podcast. We really appreciate you taking time out of your day to listen to our podcast. If you would like to connect with us in the future, you can find us on LinkedIn. Simply search for Werner Minchell or Mario Parzino. Also, you can find a link to our LinkedIn profiles in the profile section of the podcast. Thank you again for listening, and we look forward to connecting with you in the future.